In this pod, we're going to look at an income statement to help you understand the main parts of it.
Firstly, it's important to note that an income statement is also called a profit and loss account. So, if you see these different names being used, they mean the same thing. An income statement is a document that any business can produce. It shows the money the business earns, the money it spends, and what's left over. A limited business, such as a public limited company or private limited company, has to produce an income statement every single year, showing all of their previous year's incomes and costs.
It's laid out in the following order, and although it can look confusing, it's quite straightforward when you get used to it. The first thing businesses list is their revenues, which is the money they earn. Then they list their cost of sales, which is the cost of buying in or making stock. If they then take their revenue and subtract the cost of sales, it gives the gross profit.
Following on from this, the business lists their indirect costs, things they spent money on in the business that aren't the cost of the product. For example, rent, bills, or salaries. These are normally called expenses, but sometimes they're called overheads. If you take your gross profit and subtract your expenses, it gives you your net profit.
The idea is to have as much profit as possible and to keep costs as low as possible. Looking at this example, you can see the business made revenues of £100,000, but spent £30,000 on their cost of sales. This means their gross profit is the difference, which is £70,000. They then spent £50,000 on other expenses, so finished with £20,000 net profit. Remember, this is gross profit minus expenses. Just to be aware, some exam boards call net profit operating profit. At this level, they mean the same thing, but that isn't exactly true if you study this at a higher level.
Using the income statement, you can calculate some important ratios. Ratios are really useful as they help a business compare their performance with either past performance or another business's performance. The first calculation is the gross profit margin ratio. This is a simple calculation of gross profit divided by revenue times 100. Net profit margin is the same, but just change gross to net, so it's net profit divided by revenue times 100.
Looking at the previous example, the gross profit margin would be £70,000, which was the gross profit, divided by £100,000, which was the revenue. This would give you 0.7, so times this by 100 to give a percentage, which would be 70%. The net profit margin would be the net profit of £20,000 divided by £100,000, and again multiplied by 100, which would give you 20%.
So, if in the previous year the business had a gross profit margin of 80%, this would mean something has gone wrong. Their margin has gone from 80% to 70%. And this is a problem as the business wants profit figures to be as high as possible. But remember, when calculating things like ratios, they only give you an answer, but they don't give you a reason. Maybe the margin decreased because the business is now spending more on stock to buy better quality. Maybe exchange rates have got worse, which means the cost of materials has increased. The income statement doesn't give reasons for the figures, just the results.
Despite this, they're a useful guide when making business decisions. Maybe you can see that costs are going up, so you can then investigate why this is. Depending on the answer, you could then make the decision to switch suppliers or look for an alternative. Once you have an income statement, you can see how your business performed compared to the previous year. This means you can investigate any problem areas and improve profits the following year.